Woohoo! It is Tuesday, and that is Octa Day, where we look at a lot of data around on-chain, particularly to find exactly where things are going. And to find exactly where we got audio, which is great. Thank you all for being here. So good morning to everybody in Australia. I see you out there in the audience. So let's talk about, first of all, what took the markets down. And I listened to the whole Senate testimony from Jerome Powell today, and I think my IQ dropped by about 10 points. It was painful, usual stuff. I swear I'm listening to a broken record. We're seeing goods inflation coming down, housing inflation is coming down, but core services X housing is where the challenge is. Da, 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 da. Our tools are powerful, but they're blunt. Yeah, no brainer. But at least this time around, the Senate was asking semi-intelligent questions, a lot of stupid questions. But the questions were around, but you can't actually control inflation. First time I heard that. Yes, you can't control the price of eggs. You can't control the price of oil. All you can do is destroy demand. And that's what he's doing. But it gets worse than that. Anyway, the point of listening to the whole thing is when you listen to the people in control, it gives you much more confidence in things like Bitcoin, where there's no control. And that's the beauty of it. So we've got 45 nuggets to go through. Let's go through fast. We're going to dig into a lot of questions that were triggered on DCA yesterday with Ran and CTO. And of course, edutainment, you guys know the drill. And a lot of people were asking as well, what is the typical schedule for videos? So the team put together this beautiful little calendar. So Mondays is DCA and it rotates across channels. Tuesday is Octa on-chain technical analysis stuff we're doing today. Wednesday is crypto news. Thursday is kind of markets all across the board, whatever's hot, whatever's new. Friday is either news or an interview. Saturday is a quickie, finding something super interesting to touch on fast on a Saturday morning. Sunday is Q&A, questions from Patreon members. And then once a month, I do a global macro update, a global real estate update, a crypto miner update, and some deep dive into like daily active users for crypto, etc., etc. And again, the most breadth that you need to get ahead. And that's why we touch on everything that is important to make good financial decisions in a very data-driven way. So let's start with the good news today. A lot of good news, but also a lot of ugly news towards the end, so hold on tight for that. And remember, we're going to spend a lot of time on Bitcoin today, because it's probably one of the top two assets of our next 10 years that are going to be very important. So first of all, let's look at the markets year to date. Thought this was a nice little way to kick it off. And here, sorry for all the gold bugs out there. I pulled up the big categories of assets. So as you can see here, Bitcoin's up 33% year to date. Copper 5%, S&P 500 4%, dollar index 2%. Had a big spike today because of the hawkish tone of the Fed. Oil flat and gold down 1%. So that is kind of where we are. But now there's a lot of hysteria with the markets pricing in 50 basis points for March. A terminal rate of 5.5% now looks very possible. And we have this triple-digit inversion in the yield curve, which is the most inverted in my lifetime that I can remember. Also, there's a Grayscale case with the SEC. We'll talk about that later too. Gold and silver getting crushed. But Bitcoin is unmoved, and that is stunning. It is stunning. After a hard year last year, it's really strong. Let's look at where the outlier is across all different asset types year to date. So at the very top, commodities down 5%. Then you have cash up a little bit, 0.7% because of interest rates. Small growth stocks are probably the best performing asset compared to everything but Bitcoin of everything out there. And that's interesting as well. I'm surprised the Chinese market hasn't popped yet. Maybe it's not included in the study. But look at where Bitcoin is. I added a big green arrow to show you. Compared to everything else, it kind of looks like a snail. And that is where we are. So Bitcoin's doing very well so far in 2023, as we expected. Let's look at decoupling news. Let's see if there is any correlation again. So far, last 90 days, Bitcoin up 35.4%, Nasdaq up 5%. They're both kind of stagnant and flat. And that's why we can take the time to dig into some kind of newer elements. And by the way, this is Paulie. Paulie is the bear, so I have Bully and Paulie, so you can remember them. And the idea is when I am bearish, I have my bear sitting there, and when I'm bullish, I have Bully back. So Bully's out of sight right now. But let's jump ahead and talk about a reminder of where we are. And again, I can never get enough of these types of visuals. A big thank you to the team at Blockware who put this together. This is the We Are Here map of exactly how many of the global population have adopted Bitcoin. And in yellow, it's the Bitcoin issuance. So we are on the cusp of that S curve about to go vertical. And yes, the population is 8 billion people. Very, very few people have Bitcoin. And it's going to become real scarce really fast. And that is exciting. That's why everybody should really focus on being around for the next 8 years, because this will be fun to watch. In fact, if you look at this chart carefully and you go up, say from 2032, 8 to 10 years from now, we'll be halfway through the S-curve. Only halfway through the S-curve. And that is impressive. Let's talk about this other beautiful visual, which I had to share. And a big thank you as well to Sanjay for sharing as an illustration of, I'm always trying to find ways to help people understand why Bitcoin is different. And I call it a hard asset, hardest, most scarce asset, etc. But with traditional commodities, as we saw, they're down year to date. When the price of them goes up, there is a supply side response. People dig more, they mine more, they pump more oil out of the ground, they farm more, they build more, etc. The supply growth increases, and that influx of supply growth brings the price back down. But with Bitcoin, it's different. No matter how much the price increases, the supply side response will be people jumping in with their mining rigs to increase the security of the network, but they cannot adjust how much is created. That is the difference, and that is special. If there's one thing you take away from this video today, hit the like if you appreciate that one, because I thought it was excellent. Excellent. There's a lot more to come. So first of all, this is the last week performance of Bitcoin and crypto divided by Bitcoin. Obviously, Bitcoin's always flat when you divide it by itself. But here you see only things like XRP, Monero, EOS win. And it's funny how bad score tokens run counter to the market. So it's as if somehow magically people pump bad stuff when the market's down to try and attract the bees to jump in. And I've seen this happen a lot with a recent token that is now under attack by the SEC. They've changed their whole branding overnight. So super to watch. Anyway, let's talk about the crypto market over the last 7 days in terms of dollars. Bitcoin down 6%, ETH down only 4.5%. So ETH is outperforming, and a lot of people worried about Shanghai, but no need to worry because it's holding up very, very well compared to everything else. Again, everything else in the red pretty much, except for the names that I mentioned. So that is kind of the world where we live in today over the last 7 days. Now, this is from Plan B, and I know he's a controversial character. He promised a lot of people very expensive Bitcoin, which didn't happen. But he does talk about the Bitcoin Relative Strength Index, which is a very, very important index to look at. And he said we are stuck at 45. And I was like, the index for RSI is on the left-hand side axis here. And where we are in terms of months until the next halving, we're beginning to get to that light blue area, which means we are approaching 9 o'clock on the clock, midnight or 12, whatever you want to call it, is the halving time. And we're nearly 72% through that process, which is great. But remember that 45? Well, if we go back in time, and I should have tweeted this back at Plan B, but if you go back in time, way back to 2015, when most of you weren't even in Bitcoin, including myself, I didn't get into Bitcoin until 2017. But here you can see the exact same RSI, where it kind of fumbled and it stalled. But what happened after that was very, very exciting. Look at the similarity in the colors. Look at the similarity in the structure of the RSI line. And again, no guarantees, but typically, if it's anything like 2015, good stuff will happen later. So again, these things work 70 to 80% of the time, not all the time. So no guarantee there. Now we're going to dig into Bitcoin cohort holdings, where the movements have been across all the different cohorts. And a big thank you to Econometrics for this. Data saves me digging it up and putting these beautiful visuals together. But here, I basically added some little arrows beside their charts, and it shows you where things are flat. Green means they are accumulating. Red means they are selling. And you can see here, obviously, more than 100,000 Bitcoin. There's not many of those, so it's been pretty flat. Then you have your 10K to 100K Bitcoin. They are accumulating, which is very positive. Your 1K to 10K selling. And your 10 Bitcoin to 100 Bitcoin are selling too. They're kind of the richer retail investor getting very nervous. But your 100 to 1,000 are accumulating. Very important. Then your whale, your fish and your shrimp, it says your 1 to 10 Bitcoin and your less than 1 Bitcoin are accumulating as well. But let's dig into two things. One, you can see the two biggest cohorts are, of course, the 1,000 to 10,000 Bitcoin and the 10 to 100 Bitcoin. That 10 to 100 Bitcoin were the ones that did the most accumulation over the last 18 months. And now they are selling ever so slightly. So that's interesting. But let's break it down and show you exactly what has happened. So this is, again, the same thing, but a different visual of the actual accumulation by these different cohorts. Less than 1 Bitcoin, up and to the right. Same with the 1 to 10 Bitcoin in the middle, and at the bottom, the 10 to 100 Bitcoin, who had been accumulating for the last year and a half, all of a sudden started selling. But maybe they'll stop soon and start accumulating again, but maybe they're just nervous because of all of the FUD around Mt. Gox and everything happening in March. That could be the reason for this. But let's go a little bit further. Let's look at the other cohorts, the 100 to 1K Bitcoin. You can see they had been in and out. Now they're kind of back up to where they were before. So they've been accumulating again. The 1K to 10,000 Bitcoin, they've been selling off a lot. They are actually shrinking their bags to the lowest level that we have seen in quite a while. In fact, the last, year to date. And that is quite surprising because remember, they are the actual biggest holders as well. And that's, not always when you analyze where people are selling, it doesn't always reflect in price, but a lot of time it really does. And then the 10K to 100K Bitcoin, this is what has me most interested because these people are moving around a lot of money. 10,000 Bitcoin is a lot of money and they are accumulating heavy since basically December. And the question is why? Who is stacking right now with all this money and why? And this is what gives me a little bit of hope. I'm not worried about the 10 to 100 Bitcoin holders. But you see people buying 10,000 plus, stacking hard for the last couple of months. That is interesting. Now, let's talk about some other on-chain data. The all-time high, the hodlers continue to hodl. And they're now 67.72% of all Bitcoin. That hasn't moved in over a year. So there's people that are just stacking and holding. And again, it's a very positive sign. But liquidity languishes and traders have left the building. That's the other thing that we can clearly see here. Let's look at some options action. Still heavy to the right. Hasn't changed much from before, despite all of the negativity and FUD and fear around Mt. Gox and Shanghai and SEC and everything else. But you can see there's still a lot of heavy bets to the right, especially between $25,000 and $40,000 Bitcoin by the end of March. Obviously not looking likely, but still big bets have been placed here. The put call ratio is 0.49, which is also quite bullish. But again, some people still have hopes for that $5,000 Bitcoin and $12,000 Bitcoin, but they are way, way outnumbered by the call options buys that are happening now across the board. Now let's look at the top 50 altcoins versus Bitcoin and what has happened over the last 90 days. You can see Bitcoin has been moving up the chart. I like to monitor this because I see exactly, like if I showed this to you 2 weeks ago, your Bitcoin is right bang in the middle. Now it's moving up to the right. Now the old ones are still not moving. They're really languishing a lot down there to the right. It's not where you want to be. It's nice to see Dogecoin is down a whopping 23 or 28%. I can't quite see. I think it's 23%. Over the last 90 days. But thank God people are seeing what meme coins are. And then huge separation. We have the Graph, Aptos, Lido, Stacks, all up on the left-hand side doing very well. So that is interesting to see. The Bitcoin, people obviously have this flight to safety, getting out of a lot of altcoins and moving to Bitcoin during this transition period. Another good news for Bitcoin as well. This just got released. This is regarding Grayscale and Grayscale Bitcoin Trust and the conversion to an ETF. Judges apparently were now double teaming the SEC with multiple questions around one point. And that was, it all goes back to the same. It's like, how can you argue manipulation in spot wouldn't affect futures And thus the surveilling sharing agreement of futures isn't really meaningful, which is your whole point in disproving the spot ETF. And the judge's positions hinted at a favorable outcome for Grayscale, and therefore Grayscale shot up 11%. But just to dig into that for a second, it's like SEC approved the futures ETF, but not the spot. And according to the logic brains of our judges, they say, that doesn't make sense. You can't approve one and not the other. So Grayscale 1, SEC 0, hope it continues, and that will unlock a lot of value for people that own GBTC. Now let's look about how flat the market is. If you look at social sentiment, you can see here a great chart from Artemis. It looks at Twitter followers across Ethereum and Solana and Polygon and Near and Avalanche and Cardano and Aptos. Many of them are just absolutely flat. And there's no real growth. There's no real excitement in the market. And that is reflected with how many people are following. Many people are actually unfollowing a lot of accounts too out there. But there'll come a time when this will come back alive. But it was interesting for me to see how the number of Twitter followers, wonder if that represents how strong the groups are. Sometimes you have very, very strong tribes or armies behind certain names, but it's interesting to see some other ones too. Now let's jump into the stock market for a second. Real brief for those crypto fans. We're coming back to crypto, don't worry. But despite the Fed, tech is mostly up over the last 7 days. Big moves, Microsoft, Apple, Google, Nvidia, that beast, Baba. Tesla's down because people still don't understand what Tesla is. Way beyond the grasp of people really understanding exponentiality. And that's good for the retail investor. And the retail investors are the ones who have been buying all year since the bottom. Even Nancy Pelosi sold Tesla at $107 in December. She nailed the bottom. She's normally very, very good because she got good access to great information. But she didn't get that one right. In addition, in some Square news, I still call it Square, I mean Block. They still have the ticker Square. But they have had a breakthrough and they've built what they call an MDK. It's a mining development kit. And they have this thing where they envision some way of empowering Bitcoin mining for retail customers. It will have a custom controller, open source firmware, a software API front end to allow developers to modify the key performance parameters of the hashboard, not a dashboard, they call it a hashboard, and a ton of reference materials as well to facilitate this. But this would really help with the democratization of all things Bitcoin and empower people to mine themselves with relatively cheap rigs without having to buy expensive ASICs if they have access to cheap electricity, for example, in their grandma's basement or something. Who knows? Let's talk about some liquidity as well. Liquidity Limbo. This is a cool little chart from Fidelity, and it looks at how the S&P 500 tested the intersection of the two trend lines. Last Wednesday, I was very, very nervous about this falling through and breaking through that line, but it bounced perfectly off it. It's also confluent with, I think, the 200-day moving average, etc. So a whole bunch of things. Really, this shows you how people trade based on solid TA signals and TA support and resistance levels and 200-day moving averages and all that type of stuff. So that was exciting to see. But market did fall today and we're nearly back down at that level again because of the Fed jitters. Odds are tomorrow, market will digest it and say, okay, we're at 475 basis points right now. We'll go to 550. What difference is 75 basis points between friends? Everything's already smashed at this stage. What's going to happen? We'll talk more about that in a minute too. But also Morgan Stanley came out and said they were very, very impressed with that retest of support, that key support level that we mentioned. This is their other version of that Fidelity chart. And it was tested severely. Literally, market just crashed down, hit that level of support on Friday and bounced right back up. And how that market reacted around the second test was extremely impressive. And they respect how this bounced, and it gave them a different perspective of where the market's going, i.e., are we entering a new bull market, or are we going to be flat, or go down back into another bear? Now, Morgan Stanley, who are some of the best in the business, are confused. Now, switching gears, sadly, everybody, to the bad news. Some bad news. Back to liquidity. You can see here, this is Bitcoin trading volume, USD, USDT trading pairs. Liquidity is all but dried up in Bitcoin, and this is reflected in the Bitcoin price. It's also mainly due to things like the SCN, the Silvergate Exchange Network, which has been a key on-ramp for US dollars moving in and out of Bitcoin markets. Trading volume has dropped immediately after the run on Silvergate deposits, and it shows you how important this SCN was. And this highlighted this in depth last week, that the banking troubles in crypto land have dried up all the liquidity, and we'll see. But again, what is amazing is how stable Bitcoin is. And after the huge run it had in 2023, they are the positive silver linings of this liquidity drying up. Yes, liquidity is drying up, but the market's not tanking. Now, it doesn't say it won't tank, but again, it's holding strong for now. Let's look at what happened to small caps versus Bitcoin versus large and mid caps. You can see last week I did mention that over the last 30 days, small caps won the month, and they're still holding strong. But Bitcoin is now back in the lead, falling only 4% over the last 30 days, whereas small caps down 6%, large caps down 7%, and mid caps down 11%. We're seeing an interesting thing happen. It's like a very bifurcated market. People are YOLOing into kind of small cap names to get big returns. They're ignoring all the old stuff. It's all about the shiny new things like AI, protocols, etc. And Bitcoin dominance, of course, is doing well as well. So that is an interesting view of the world. It'll change eventually, but we'll wait tight for now. Let's look at money flow. This was another week of outflows. It was very, very slight outflow last week, but again, outflow nonetheless, but this time was $17 million. And this marks the fourth week of outflows, or you could construe that as negative sentiment. Again, after a great start to the year, people are nervous. They're sitting on their cash. They're not plowing into the markets. And that's what we can take away from this. Let's look at the detailed asset flows regionally. This is also interesting. The US saw inflows totaling about 10 million, and Europe saw outflows of 23 million. And Bitcoin was the focus, as we discussed already for a large part of this. But the AUM, asset under management, I think of all digital assets, has gone up 36% this year, which is extremely positive. We also saw minor inflows into altcoins last week, like Ethereum, 700,000, Solana, 340,000, while Binance and Cosmos saw outflows of 380,000 and 210,000 respectively. And XRP is flat despite the price action you see today. Now, back to Bitcoin season. Here you can see we hit, in the time between last Tuesday and today, Bitcoin hit that 25 level. And the reason this is significant is typically every time it does this, 80 to 85% of the time, altcoins then rally. So we've had that flight to security, people moving out of altcoins into Bitcoin, hit the bottom, bounced. Now the altcoins, I believe, will rally. Be interesting to see where we are next week. Will we be above 26 or 27? I would bet my bottom dollar on it. So mark my words. Come back in a week and find out. Let's look at, this is an old one that shouldn't be there. Let's look at the Fed and the FOMC, because everybody is still under that big umbrella, making everybody nervous. The 50 basis point potential hike in 2 weeks from now is now at 66%, and a week ago it was at 25%. So it's a big, big move. Everybody's now factoring that 50 basis points in. But after listening to that Fed testimony today, he was just being hammered by senators saying, you can't control inflation. Why are you jacking rates? You're increasing the deficit. You're destroying jobs, etc., etc. He's like, and he goes back to his, well, our target's 2%. Yeah. Okay. Anyway, this is how the Fed operates. It's how they measure stuff. So this is a beautiful chart from Trueflation. And if you look at the Trueflation housing year over year is the blue line. Okay, this is the truth. And then the yellow is kind of the Bureau of Labor Statistics Shelter Index. That's what the Fed looks like, looks at. And you can see the Fed are still looking at a yellow line that is very lagging, and it's still going up. Whereas the blue line, the reason I'm sharing it, is it just crossed through the yellow line. And it shows you the Fed is watching yellow. The truth is blue, but they don't realize it yet. Anywho, enough of that. Let's talk about labor market, because that's also a big labor market number today. And again, this is another source of truth. This is LinkedIn hiring rate. And you can see here from the chart, it is down and to the right, and it has crashed. Now, unfortunately, February is a month of bad news. The US LHR, which is the LinkedIn hiring rate, was down 6.5% month over month seasonally adjusted. And that's the biggest 1 month decline since COVID in March 2020. And hiring is now down 31% from April 2022 when the declines began, and 28% year over year. So companies are not hiring. You'll hear the Fed saying there's for hire signs all over the place. Yeah, but they're for minimum wage jobs that nobody wants anyway. Speaking of jobs that nobody wants, this chart says it all. I don't mean to be harsh and blunt here, but literally there has been a structural change in the way labor markets work since COVID-19. Also demographically driven by people retiring, etc. But if you look at this is the top mark is US total job openings, still up and to the right, and the US job openings per unemployed person up and to the right. But the point is, the unemployed people don't want the jobs that are open. Okay, this is the big issue that nobody seems to talk about. US non-farm payrolls are forecasting 200,000 new jobs, but the market expects the labor market to remain red hot. But I don't know what they're looking at. And again, I go back to there's like 10 million people that have 3 jobs or more. That counts as 30 million jobs. It's just, again, it's weird that nobody can see this type of stuff, but people do not want to work in the jobs that are out there. They want to do their own thing. Now, another view of this, and a big thank you again to Sanjay. This is from Jeff Eniger, and he talks about the inventory liquidation sale for the labor market. And again, he kind of reiterates the way that the Fed is looking deep into the rearview mirror, don't really understand what's going on. And he says, mark my words, the labor market is going to crash after the Fed finishes hiking. Okay? Remember, it's like I always say, by the time governments say we're in a recession, we're already coming out of it, and the markets have long rebounded. The same thing with here. By the time the Fed finishes hiking, then the labor market tanks. It's kind of remarkable. But the post here is everybody's posting jobs, but no people are getting no applicants. Workers are quitting all the time. People apply for jobs, but don't show up for the interviews. And that cycle ends soon with a complete liquidation. So it's a very structurally different labor market that nobody's ever seen before. Therefore, nobody understands. It's kind of like Tesla. People don't understand it because they've never seen it before. Makes sense? I think so. Let's talk about more labor data. And sorry for going on about labor data, but it's so important for the macro we are running. Zuckerberg, Meta, he has dubbed 2023 the year of efficiency. And the company has been communicating that theme to employees during performance reviews. And they were completed last week. They have asked managers to identify people that they can lay off. They're going to be doing a second round of layoffs, unfortunately, soon. But here, this is an interesting stat from Bloomberg. It shows you all the headcount that's been added between 2020 and 2022 and how much revenue per additional headcount has been generated. So if the blue is bigger than the black, it's a good sign. That means Apple, Google, and Amazon are good at managing new headcount. But all the others, Microsoft, Salesforce, Meta, they have not made that. Basically, they have become far less efficient and effective when they add new bodies. Key takeaway here. And much of it might be due to some of the structural changes in the labor market as well. In addition, let's look at this one. Hat tip to Ray Dalio. And I know some people don't like Ray Dalio, like some people don't like Plan B, but this is something I've been talking about for a while, but I never had the graphic to go along with it. So this one does come from Ray Dalio. And I just want to share some information. And I don't want people who are kind of pro-dollar, love the dollar, etc., throw rocks. But this is just numbers about how the world is changing fast and how we need to prepare for that. That's all I want you to take away here. And these arches, that look like McDonald arches, are not representative of actual linear numbers. So I did add some stuff myself, but I added the dollar as a share of global reserve currencies hit an all-time high of 75 about back in the 90s. I can't remember if it was 96 or 97 when they hit that all-time high. Now it's 59% as of 2022 year end, it was 59%. And I expect it to go down further because the Chinese And Saudi Arabia and the BRICS and all these other groups, they want to trade in their own version of a currency, or the Chinese want to shove the digital yuan down the throat of people that they do trade with. And both these so-called, I wouldn't call them, let's call them not friends of the US, like China and Saudi Arabia, they do not want to do deals in the dollar. They want to do it in something else. And this is why the dollar strength has come down. The question is, what will emerge as the new reserve currency? I always spoke about a three-way war between US dollar, Bitcoin, and digital yuan. It might be a BRICS currency or something else in the future. But the point is, these two will emerge. How much they'll emerge, I don't know. But it's important to have a piece of them. So as I lose my throat into the ugly part of the news today, I'm afraid. And for those who are asking, I start with where there is most of the news. If there's more good news than ugly news, then I do that first. If there's more ugly news than good news, I do ugly news first. So that's how this works. Now we'll talk about the ugly news and the unlocked news, which is very, very important for people to know. And when I share this, people are like stunned every single week. So it's become a section. So if you hold any of these coins, watch out. So Tornado Cash, these are some big unlocks coming over the next 7 days. 1.4 million will be released in Tornado Cash, 4 million in Moonbeam, $50 million worth of Aptos will be dumped on you guys, 1.3 million in Sweatcoin, 200 million in ApeCoin. So let's go ape into that crap right now. Only kidding, of course, everybody. I hope you understand sarcasm. And Stargate, $500,000. So watch this. Do not be a victim of getting dumped on. It's no fun. Let's talk about other really ugly news. This is LIBOR. I remember this was a key number for me back in the 90s. We used this to determine the value of everything, every product, risk product that was sold. The 3-month London Interbank Offered Rate, that's what LIBOR stands for. And this is for dollars. This is the global lending benchmark that everybody uses. Surpassed 5% for the first time in 15 years, over 15 years actually. And it's driven by expectations of Fed tightening. And this rate will hurt businesses, it'll hurt commerce, it'll hurt financing. It's going to make those companies that have to borrow a lot of money or have a lot of debt, have to refinance the debt, much more expensive, and makes trade as well much more expensive. So this is going to also hurt the global economy. In addition, speaking of debt, US credit card debt is heading towards $1 trillion, and that is scary. The consumer, despite what the Fed will say, is not healthy. The consumer is living paycheck to paycheck. And the fact that credit card debt jumped 70% in 1 year, 17% in 1 year, and job losses are about to roll in, this is going to be very ugly. And there were senators that spoke about this today, actually in the Senate here with JP. And he's like, I don't care, I just think about 2%. Which US inflation has never been 2% in 40 years. So it's a bullshit number to begin with. Sorry about using French. So that's the credit card debt news. And what's ultimately the result of all of this? This is a beautiful chart from Molten Economics and how that green piece is the net... Greenpeace sounds like the Greenpeace shit people. But the net interest of how much that's going to grow over time. The black line is your tax revenue. The rest is deficit, ladies and gentlemen. Everything above the black line, you got the blue, which is mandatory spending, all the Social Security, Medicare, social programs, etc. And then your defense spending, which is kind of shrinking, despite the fact the world is getting hotter and hotter. And then the interest is growing, and then everything else. So it's just, the deficits are just going to explode. The debt is going to explode. And they're jacking rates on themselves. And this is the piece that my reptile brain can't wrap its head around. So anyway, I just want to leave you with that. And to prove how shaky the ground is, another data point. I wish Greg Foss is here to chat about this because he loves CDSs. These are credit default swaps. It's a financial contract where one party agrees to compensate the other party in the event of a blow up. And there was talk about this today as well. Will the US default? Well, if you look at the numbers, just hone in on the US, it's AAA plus, or it's AA plus, not even AAA. The variation of CDS price has gone up 15.43% in the last month, 85% over the last 6 months. Okay, this is the cost of US default risk insurance, and it's going up because if you had the balance sheet of the US government, you would not be able to borrow a penny anywhere. But the good news is the US government can print it themselves. And that's the news for today. So sorry for getting very animated, but this is why we Bitcoin, as I say, new thing. So thank you everybody for being here. Thank you to the mods in the chat. Again, hold on everybody. It's going to be an interesting future. And stay well, stay healthy, and I'll see you all soon. Let me find the outro. Boo.